Hey everyone, it's Zach Perry. Welcome back. Thanks for joining us. We are going to talk about something I promised you we'd talk about. We're going to talk about fluctuating versus average returns in the stock market. Now, we're used to talking in averages, right? When we talk about stock market growth over time, we hear averages. The stock market has grown by an average of X, or my mutual fund grows by an average of X, okay? But I want you to understand that when you hear that number, that is not the growth that you experienced. Okay, because there is a large difference mathematically between average growth and actual growth. And here's why. Let me illustrate this with a simple principle. Number one, let's suppose that you invest in a given stock, right? So you can invest in stock A. Let's say you put, on Monday, you invest $100 in stock A, okay? By the end of Monday, your stock has increased by 50%. Okay? On Tuesday, we'll say the stock decreases by 50%. So the average rate of return, that's positive 50 plus negative 50 divided by 2, is 0, right? So you could say at the end of Tuesday, that the stock I invested in has experienced a flat growth rate, an average rate of return of 0%. But how much money do you have? If there's flat growth, you should have $100, right? Well, if only it were so. Let's do the math. At the end of Monday, after your $100 has grown by 50%, you now have $150. Then by the end of Tuesday, when it's dropped 50%, you now have $75, which means that the stock has experienced 0% growth and you have experienced 25% loss. It doesn't really seem fair, does it? But that's math. That's what happens when we talk in averages. And the reason is simple. When you take 50% of the first on day one, you're taking it of $100. When you take 50% on day two, you're taking it on $150. And there's a universal truth, and that is when you look at a graph of growth and loss, you are losing on the big number. So the percent loss is on the big number, and you're earning on the little number. Okay? Now the same is true if you lost first and then gained. We can do the exact same math. So if you start with $100, and then the stock goes down by 50%, you now have a $50 stock. Then if it goes up by 50%, 50% of 50 is 25, so 50 plus 25 is $75. You end up at $75. The stock market, again, was flat at a 0% average return, and you are now down 25%. Now we can look at that on a grander scale. Now I have created an Excel spreadsheet. This Excel spreadsheet is way more complicated than you need, and it's to calculate years worth of growth and taxes and all that stuff. But column L here is what I want you to look at, because what I've done is I have taken and I've kind of simulated stock market performance, right? Now, I haven't gone to the great extremes the stock market goes to, because every 9.875 years, the stock market corrects by 44%. That's, again, averages. So what I've done, and if you watch my other video, you'll know that the Dow Jones Industrial Average over 124 years was 5.30% average growth. So to calculate, I have used varying growth rates. You'll see here the first few years, the first 8 years, 10% growth every year, and then a 35% growth or loss in year 9. And then you see 10 to 11% growth the next few years, and then 35% loss. So I've kind of simulated without using extremes, in fact, using fairly good low numbers and lower high numbers. So 10% every year is good, 35 as opposed to 44, right? With an average, you'll see down here in L46, the average rate of return is 5.30%. So I've taken fluctuating 10, 10, negative 35, 11, etc. Fluctuating every year, just like the stock market performs, but the average is 5.30%. And you'll see for our purposes that this person who is contributing $19,500 a year to their 401k and $16,500 to private investment, but assuming this growth rate, after 34 years, the balance in their account is $814,221. So they start with zero, they're contributing $19,500 every year, and so they have $114,000 after an average 5.3% growth. But what if instead of these fluctuating rates of return, we just stick 0.053 or 5.3% in every year? What is that $814,000 number going to turn to? Well, let's just plug in and see. If we go 5.3 every single year, now the average is still 5.3, obviously, but now we've got $1.291 million in the account. So it went from $814,000 to $1.29 million when we used the average as opposed to fluctuating. So when the stock market, which is not average, you do not see a straight line on the stock market curve. I want to do it this way because that's what growth means from my perspective. But from your perspective, you do not look at the stock market graph and it goes like this. The stock market graph goes like this, right? It's like someone with an irregular heartbeat or something. The average, if you were to draw an average line, you'd see that line, but that's not what you're getting when you invest in the stock market. You're getting the actual returns. You're losing at the crest, and then you earn again at the bottom, right? So you have to realize that. When you get your statement and it shows an average of 8 or 10% growth or 4 or whatever it is, that's not your real growth. You can do the math. You can say, well, how much did I put in and what is it now? It's not going to equal that average because of the math that occurs on the fluctuating graph in between. So hopefully this has been educational, eye-opening for you. You really, if you're going to make investment decisions, you need to understand what's happening with your money. That's the idea here, is to get you out of the conventional thinking box and see what things really are. Get out of the average thinking and start thinking like an above average person. If you have any questions, you want to talk to me or my staff, you can reach out to us. My phone number, my website, all our contact information is on the website, which you'll see at zachariahperry.com. And if you call my office, I guarantee you that someone, whoever you talk to, will put a smile on your face. If they don't, you let me know, because we take smiling pretty seriously around here.